Welcome to the Real P&L Trading Show, where I share my real P&L on 3 accounts and share my proprietary SafeWheel options trade system for free. I want to make sure you guys can hear me okay. Type in the chat that you can hear me to let me know, give me that feedback that let me know that the audio is working. I've made videos before with, I thought the audio was working, but it wasn't. So I want to check that. Also, be sure to post any questions. Jeff says audio good. Charles says so. Thank you. Also, post any questions you might have as early as possible because sometimes I'm ending the broadcast and then people are asking questions there at the last second. I think it's on maybe a 3 or 5 second delay. So please try to get those in sooner rather than later. Okay, let's start here with the earnings edge. We can see here my account is worth $10,800. And last week I traded Costco, made $564. So let's look at that on the spreadsheet here. 10,799. Okay, so Costco 564. Since I did my update in 2022, my record's 20, 19, and 7. So I remember last time, I think I was 17 and 19. So I've had like 3 wins in a row. And that's what happens. I'll have 3 losses in a row. I'll have 3 wins in a row. Average win 847, average loss 491. You can see the results in 2022. In 2023, not too bad. Underperformed there, overperformed here. And let's put this in here. And what's the S&P trading? What's SPY trading right now? 512.27. So S&P is up pretty good this year, almost 8%. Earnings edge up 12.5 or 12.7. You can see that the earnings edge is up about 116% since I started in 2022. S&P is up about 7.86 since the beginning of 2022. Obviously, the earnings edge is vastly outperforming. There is a lot more volatility in this account. The volatility is probably 3 or 4 times higher. So you have to take that into consideration too. But the earnings edge is doing quite well this year and overall. Okay, let's talk about the Premier Level 5, 33,604. This one's been suffering a little bit because of this high run in this bull run without any volatility. This thing needs a little bit of volatility for it to kind of collect. And without any volatility and in combination with a bull run, sometimes it suffers. Once the S&P pulls back maybe 2, 3, 4%, and even 5, this thing will get all, it'll recover and probably even surpass or at least catch up to the S&P. So 33,604. So you can see them down 4.31. Don't see heavy drawdowns. This is probably the most drawdown I've seen with the PL5 since I started in April 8th. And then, of course, we have the S&P outperforming this year. But I have about 1/3 the drawdowns. So, that's still underperforming for sure. You can see it's 12% versus 25%. Again, about 1/3 the drawdowns. So you could multiply that times 3. On a risk-adjusted basis, it is outperforming, but nominally not outperforming. Obviously, I prefer to nominally outperform also. I am not worried about this. Eventually, there will be some volatility in the market, just a little bit of volatility and a little bit of a pullback, and then this thing will recover. Okay, so the PL5, that was the PL5. Okay, let's get into the SafeWheel. SafeWheel is interesting. So down $34 on LI. So I opened LI, was it 2 weeks ago? Maybe 3? I don't remember. But I was going to get out of LI and get into another stock. I was going to get into LUV. But it's down 12% today. So because of the fact that it's not over $40, it was around $45. So last week, I did not even put on a long call because I was going to not be in the stock because it was around $43, $45. It was well over $40, so I was not going to be in it. But then today opened up and here we are. So I'm still in it. So let's take a look at the positions. Typically, I'll have a long call because I would put that on last Friday, but I'm going to put it on today because I didn't think I'd be in the stock. And then we have the put hedge, which is doing, much better. You can see the put hedge is actually kind of helping my position, right? And it made it to where LI, it was down quite a bit year to date, but now it's only down $34. So it's acting normal now. This huge bull run in LI kind of pulled my account down a little bit, a few $100s. I think it was down $300 on Friday, but all recovered here. And that's what happens, with the safe wheel. If you get a stock that just goes up, 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 up without any retracements, you might take a loss as it passes $40 and then just get into another stock. But you can see what happened here. So the trading I'm going to do here is I'm going to buy the long call first. Something that expires at the end of this week, which is in 4 days. Today's Monday, so on Friday, I'm going to look at the calls and I'm going to buy something around $5. You can see there's quite a bit of volatility. Look at all this premium. So this stock right here is moving a lot compared to probably normal. Let's look at something here. Look at how much movement we're getting in here, and the volatility is up quite a bit, which is fine. So it doesn't matter. You just play by the rules. I don't know if I can get this for $5. This one I can probably get. So the 47.50, kind of widespread there, but I'll just buy one because I have between $5,000 and $10,000. So I'll do one of these. I'll do one. I'll sell a put. I'll sell one put, and then I have 3 put hedges. I have to look at that put hedge. I'll do that too. Make sure it's in line. Try to get this for $5. Let's see what I get for it. Okay, so that filled right away. So I probably might have got it. Could have saved myself $1 or something there, but that's okay. Okay, so now I have my long call. Let me look at the put hedge here. First of all, is this $32 within 70% of 38.43? So let me look at 38.43. I'll just use my calculator here on my phone. Let's call it 38.5 times 7. Yeah, so as long as it's above $27, which it is, that's fine. And then I have 109. So if I was under 100, I would roll this because it would have too much depreciation to do what I need it to do. But the put hedge looks fine. I also have my long call now. And so now I'm going into the traditional wheel. So I'm just going to, I don't own any shares. So I'm going to sell a put. And I'm always going to do that in the nearest expiration cycle. And what I like to do is I want to get at least 1%. So at least like 39 cents out of the money. Okay. Out of the money up this way. I'm going to get at least 39. So I could do the 36 right here. And then I like to go one back, collect a little more premium, but I like to be as far out of the money as possible. So my put hedge will protect me. So I'm going to sell one of these, mid price 58. I could go for 59 cents, but no, I'm not going to do that. Okay, so filled there at $58. So I collected $58 in premium. I'm really nice out of the money. So if it comes down and I get assigned shares, my put hedge is really going to be helping me a lot. So I like to get as far out of the money as possible so my put hedge becomes more, it helps more. Okay, check my notes here. All right, so pretty straightforward here on the safe wheel. And I'm wondering if there's any questions here. Shovel says he's first. Okay. What's up, Shovel? Okay. Rich has a question here. When you have 200 shares of stock and you're selling a call, how do you indicate you want the most recent purchased shares? Oh, okay. So in other words, how do I know what I got assigned, what my assignment price? Is there a setting in TOS? You know, it's interesting. I do set it in TOS, last in, first out, but it'll show me the trade price in here. And typically that trade price isn't accurate for my first 100 shares. And then I have my second 100 shares. So I actually have to physically write that down, how much my each one of those individual 100 shares where I was assigned. So I have the one price in here, and then I have another price written down in my notes. I'm sure there's a better way to do it. Maybe a spreadsheet or something. But yeah, that's the way I do it. Will says, LI dropped in time to keep you in. I know. Interesting, huh? It was right at $40 last week, so it was barely stayed in. And then it went up to like $45, and I'm like, man, should have got out of it. But now it's all the way back. So I'm not, basically almost at break even with it. Hopefully we'll make some money with that one, because you can see with DraftKings made, $500, and LI is just below break even there. Okay. Nina, in the safe wheel guidelines, it says if tier 2 is not profitable and we can't sell any covered calls for more than 1%, hold until we can sell a covered call. Wait, does it say that? I didn't. Okay. Is there a limit to how long we should hold? I don't. If that says that, that's not the way that I trade it. I have to take a look at that. That shouldn't say it that way. What it should say is, if you own 200 shares, right? Okay, let's see. You're saying if T2 is not profitable, right? So you own 200 shares at this point, and you can't sell any covered calls against those 200 shares. You're going to cash out with your put hedge, and you're going to cash out the 200 shares, and you're going to start over, even if it's at a loss. So if you can't sell any premium, you don't sit there with two dead soldiers and just hang out. That's the traditional wheel, just hanging out. Let's just wait, a year or even 2 years. I've seen 3 years. I've seen where somebody's waited so long that the actual price of the stock went so low that there was no longer options available on that price. I'm not going to do, we're not doing that kind of thing. If I can't get any premium, I'm going to clear the board and start over. I'm not going to sit and have a wounded soldier and not have any type of opportunity for the system to bring in premium. That's one of the keys to the safe wheel too. You're always bringing in premium. Will, can you expand the part that lets you see the strikes of your positions? Sure. Yeah. Okay. Thanks, Will. Yeah, I should always do that. You can see the strikes here. Sold the 36.50, bought the 47.50. Any thoughts on Bitcoin? Are you a fan of Peter Schiff? So with Bitcoin, I bought Bitcoin when it was $100. I bought 20 of them, but I used it to buy some other coins, and that didn't work out. But when Bitcoin was around $3,000, $4,000, $5,000, I bought a little bit of it. I was waiting for it to come back down to around $15,000 to buy more. I wanted to own one full Bitcoin, but I own a half a Bitcoin, which is not bad, I guess. When it was down to around that $17,000 level a year ago or whatever it was, I bought more, and I was looking to get into a full one Bitcoin just to have it and hold it forever. And I have a half Bitcoin now. And I think my cost basis is, I don't even know what it is, maybe $8,000 or something. But what do I think about Bitcoin? Just kind of an insurance policy, just hold it, and maybe it goes to $1 million or $2 million or $50 million. I don't know what's going to happen with it. Who knows? But I threw a little bit of money at it when it was lower, and I'm just going to hold it. Not very much. Like I said, maybe $5,000 or $8,000 total invested. And what do I think about Peter Schiff? I think he's cool. I think he likes gold and he doesn't like Bitcoin. And the points he makes seems to be valid, but it's not really about whether you're right or wrong. It's about reality, right? Reality is Bitcoin's at like 65,000. That's reality, right? Okay. Rich, when you rolled up the put hedge last week, I'm a bit confused on how you get the best price for the buy and sell because you specify one price for both transactions. I'm assuming you're talking about trade execution and what's the best way to execute trades. Really, the best way to get the best price is to roll the whole to buy one and to sell one and buy one at the same time together, at the same time. So you're rolling. So it's two transactions into one. I don't remember what I did last week, but when you do two transactions at once, you're buying one and selling the other. Therefore, they kind of offset each other when it comes to slippage. So that's typically the best way to do it. Individually, it's probably not as good. It's better to do them both at once. Sometimes I might do them individually just to help people understand what's going on, as opposed to doing a spread. Spreads complicate things for people that are newer. So I might have done it on an individual basis rather than doing it through a spread, but it's always better to do it through a spread. All right. I don't see any more questions. I know there's a little bit of a delay, so you guys might have come in with a question here at the last second. But I think I covered everything. No more questions. So one thing I always like to say, oh, here's another question. Hi, Carl. Have you heard of Tom King? I have heard of Tom King. I've looked into Tom King a little bit. He's kind of on my list to kind of get more detailed. One of the things that initially comes to mind, all right? Any thoughts on his 112? All right. So my thoughts on the 112 is that it's uh, not positive VAMA, because the one and then the two, you've got more shorts than you do longs. And you've got those two shorts, those two teenies that you're short. You should be long those two teenies, because in a crash, those teenies can go up by, I've seen them go up by 90x, right? So if you are short at $1 and now you have to buy it back at $90, you are in trouble, big trouble. So what I think so far is the 112 is doing very, very well in this environment. But what will happen in a crash? Now, there's only been 3 crashes in the last 10 years, but one crash can take down the whole account. Now, maybe he's got some type of hedge going on to counteract that. I don't know. I haven't looked at it in details, but he should. If he doesn't, he should for sure, because that 112 in a crash is going to suffer because it's not positive VAMA. You got to be positive VAMA in a crash. You got to be long volatility in a crash. That 112 is short volatility, and it's short volatility significantly short because you're short those two teenies. That's just my quick thought. I haven't even looked at it in detail. I just, looked at it one day. It's just a quick thought. So maybe there's something in there I don't know about with Tom. I haven't looked at it in detail. Rich, should you then use one order to buy the call and sell the put? Not necessarily. I mean, I could do it that way. It's just that would be a little bit confusing because you're buying a call, selling a put together. But yeah, I mean, you could do that. The problem with that buying that call, it's only $5. So sometimes at the end of the week, that call is so far out of the money, there's no market for it, and I can't even sell it. So sometimes you don't want to be dealing with a leg that you can't even trade because there's no volume at all, and then adding it with another leg. So I wouldn't do it that way. If I was rolling my put hedge, if I was moving my put hedge into the same, using the same underlying, right, just moving it further out in time, it's it's advantageous, I would say, to roll to do that spread there with the put hedge. So guys, this thanks, very useful. Okay, you're welcome. Just my initial thoughts on Tom. I haven't got any details, so I can't really say, but just thought 112, my thought on it, just off the top of my head. Okay, guys. I appreciate all you guys, and I like to say this in parting: if the P&L is not real, what else are they trying to conceal? I'll be back next week.